Hello, everybody. All right. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so you can pass your wealth off to the next generation. As I was prepping this video, it really took me a while to process what's going on in the market right now. It's and we'll get to this. There are I think some longer term trends to look at than what most of the so-called experts are talking about in the news. Um, I went through all my data yesterday, let it sit for about a day, or say let it sit for about 24 hours, and came out with the strategy that I'm going to talk about this week. So, in doing that, that means I got to share a screen. So, this is the closed-end fund master. At the bottom, it's got So if you haven't seen these videos before, it's got flags like individual company flags that I look at, all based on different recommendations and what I read. The complete list of closed-end funds gets updated once a month. Everything that's purple, blue, or green gets updated weekly. Yeah, everything else gets updated monthly. Uh, you have our portfolio from last year, along with the portfolio and dividends for this year. Uh, our portfolio tracks monthly gains, monthly over or the annual projection, and that it also looks at where we are so far this year compared to where we've been overall. So where we started maybe April of 2021, all of 22, yeah, and so far 23. So yeah, so what we made in April, let's say what we made in 2021, what we made last year, and then what we've made this year so far, that's not exactly true. I'll go back and state this. Yeah. So what we made last year, what we made this year, or what we made 20 in 2021, what we made in 2020, what we've made so far this year, and then a running total of everything. I don't quite know why that's a different 10, 12. That ought to be a different number. Um, and then the past videos. So I've made videos explaining all of these lists, and pretty much the date on here corresponds with the video. This one is empty because I do all of this live. So in the master, we sort by discount, and then we look at targets. Current goes with how many shares we actually own currently. So let's sort by discount first because we don't buy premium. Break even is all right if you want to break even, but we don't buy premium. And then we sort by yield. I've been trying to stick with 9% and above. Um, and that works out. So KMF supposedly was bought out by its sister KYN. And it's not a straight one-to-one transfer. It's a cheaper share price than its sister, uh, but it's not a straight one-to-one transfer. as far as I know, the deal is still going through, but I haven't heard anything about the deal actually going through. AOD we bought, the discount never really changes. It's pretty much the same, and it's marked that way. It's currently 13. Still, yeah, never really. Maybe I'm off in that. Say in the past, it hasn't really changed. It's creeping to almost double overall. AGD is the same way. FEI, I like the fund overall, but their dividend has not raised since COVID. Every other uh, energy transfer, oil-based, utility-based company has increased their dividends, at least of what we own, has increased their dividends since COVID, but FEI has not. So it's not really been in my favorites list. It's also currently above, oh, let's see, stock, FEI 787, 98, it's currently above. That discount-wise of what we're going for overall, um, if you look at, there we go, currently at minus 14. So overall, it's higher than it has been the last 5 years. And historically, it's a lot higher than it's been. So in that regard, it's a good buy. But again, I'm trying to keep the yield at 9% or above. That's just me. So then I can go back and briefly sort this out. So we're not trying to buy anything we don't already have. If we did buy something we don't have, see who else is still in the list. Realty's tempting. Say so MDXG of what we've already bought. This is higher than what we bought it at, which is why it's marked that way. That's the current discount. It's below its 1 year average. It's not that old of a fund, but I think the tech bubble will eventually pop. RQ. Yeah, I think bonds are a great play, but this one's a little pricey for me. And say I'm basing everything on this overall discount and the current price, or say the current discount does not, a little bit higher than the 4 year. It's not that old of a fund, but it's not close to the 3 year. The other fund that's interesting is this. Um, that's an interesting build portfolio. So let's go back. So let's look at targets and we'll go from there. So based on discount 5.6, it's really trending close, say really above where it has been historically. So it gets eliminated. NML is more than what we paid for it. All of these funds are like they're at discount, and yes, like they're good funds at discount, but they're not double the historical average. So we're looking at the overall discount plus above that 9% threshold, which all these are. But the discount is huge, and that's kind of the first factor. So as we come over here, so yes, we don't pay premium, meaning discounted below, right? Premium will be above. And we're looking for double the historical or double the 5 year or finally below premium, which there are a couple funds that really don't hit discount that often. They really just sit above premium, or they sit above zero. So they sit in premium territory all the time. So when they dip, they don't dip that far. and they're generally a good buy, even though they don't dip that far. Are we 12? Right. Last week it was over 4. This is the final edge. But last week it was a closer to 14. So it would have been closer to that historical discount. This week, not so much. All of these are, I mean, they're great discounts, but they're not close to that historical discount level. So we can eliminate these. And that leaves us with this. So what do I see through all the reading that I'm doing online? Oil remains huge, and oil will be huge regardless of what happens to the economy. Utilities, bonds, banks, but like the bigger banks, not the smaller banks, not the regional banks, um, private equity or business development companies, and technology, but not in the sense of general technology in the sense of semiconductors. But the interesting thing of all of this, so oil controls everything, just the overall economy, but just the overall production of technology, the overall building of infrastructure. So I don't think the world will ever go green because the whole green industry is really just it's propped up. It only exists based on government subsidy. It can't compete with oil and coal otherwise, or nuclear otherwise. So as we build the infrastructure in this country and as other countries build their own infrastructure, all of that is diesel and oil based. And in fact, when you're building green energy, that's not a battery powered forklift, or that's not a battery powered backhoe, or that's not a battery powered dump truck. All of that's an oil based infrastructure mechanism. So oil is huge. The semiconductor world of things, I think the AI bubble will eventually, maybe not crash, but I think that sector overall, what's really been propping the market up recently, I think that will drop a little bit. Um, but as you make semiconductors, as you make those microchips, it actually takes oil to do that. Now, it's not, turning oil into that. It's the derivatives of oil that actually make the microchips, along with the refrigerators, the phone, this laptop, um, more than you realize, relates to oil and the subsequent production or kind of like off production of oil. Uh, with the Fed hinting, they're kind of teasing that they're going to pause interest rates, and that they are, I think, nefariously, but they're starting to print money again. I think banking is a decent place to go to. I also think real estate is a decent place to go to. That's been a very hammered sector. Um, but with rates pausing, that's going, or at least seemingly pausing, that's going to heat up again. Um, and then same thing with lending. Banks as a whole, but also just the business development companies, that will start to take off as well. So how do we process that with this list? And where would I go? We own everything in blue. CHW has been on my watch list a while. Um, their dividend has dropped a little, but it's tempting. That's, excuse me. These two. So yeah, we own everything. Of where I would go first, I would go oil first, which is KYN. Hey, look, it actually worked today. Sometimes the numbers like to appear otherwise than just numbers. This spreadsheet is a duplicate of that spreadsheet. All the formatting should stay the same, but every week something else changes. So I would go with oil. After that, I would pick technology. Excuse me. Um, there are people who like HFRO. I'm just not on the bandwagon. I like the sister company and how it seems a little better set up from what's in the portfolio. They've actually raised the dividend versus HFRO has not. Excuse me. Um, hmm, let's see. Sorry, allergies. Let's see. Well, let's pull up the CHW. Calamos generally it runs great funds. Yep. Dividend drop late last year. Pricing, I mean, the last 5 years has been almost even. This will tell you the top 10 tech, 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 Ford Motor, Amazon, which is still tech based. That's tech based, tech based, tech based. I don't know anything about K. If you wanted more, let's see what else. There we go. So you get a really good mix. I mean, yeah, technology's high, but you still get finance, you still get consumer, still get healthcare, and I'll scroll through these for you. Yeah, so we have not bought a new fund in a while, but that's tempting. Um, and that's tempting. And this is a hard list to screen out. That's heavy tech. That's heavy tech. Let's look at that. Look at overall distributions, consistent since mid 2018. There we go. The last 5 years, it's been at a discount. Generally, it sits in premium. Portfolio, yeah, tech, National Grid Utility, IBM, restaurant brands, AbbVie's, healthcare, Coca-Cola, European. If we want, we can run the same. Well, Morningstar gets touchy, so we'll say HTY on Morningstar. Shareholder portfolio. Like I need a background noise. The Jeopardy music comes to mind. Healthcare. consumer, tech, industrial, communication, financial. Nice mixed portfolio, and my fridge running heavy in the background. There are others, just the one. Equity. And more semiconductors. So my attempt is always to build more monthly income, but that's hard with a curated list. The list is what it is. Like this is the best of the best based on current trend. So of or I would put money. Oil, yes, because that's the forefront of everything. Uh, Private equity, business development. I'll put that as my last. And I like these other funds. I mean, I love these funds, but when you look at investing, much like if you look at paying off debt, if your goal is to spread out your targets, you end up with less concentration where you're investing. So it's like you could buy everything, then you have a small volume of everything. But at the same time, if you can kind of narrow that funnel, you get a better investment. You get better outcome. So I hope that makes sense. I hope you follow my reasoning. I mean, those four are the top selections for the week, and that CHW is tempting to me. Yeah, for a lot of reasons. So if you like the content, consider subscribing to my channel, and then head over to Facebook and join my group there called Navigate Your Finances. The link will be below. Um, and as I go back through this, I don't actually remember if I went through some of the stuff that I normally go through, and I want to make sure I go through it. So if I duplicate what I'm saying, then I apologize in advance. But the stuff that I generally say on every video. So this video is the closed-end fund master, along with the contents of the closed-end fund master and how we're using that data toward picking our stocks for our self-managed portfolio. This is an unedited video, which is really confirmed if I didn't say this in advance and follow my own script. The disclaimers, I'm not going to read all the disclaimers like I used to. The two that I'll mention is that I am not a financial advisor. I am a financial strategist, and that I don't speak like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. As I sift through the different sources or what I'm seeing online, Webull allows me to see a lot of general financial advice of the people that I subscribe to and pay for. I only pay for one thing. It's the Contrarian Outlook run by Brett Owens and his crew of people who do a great job giving a very different outlook and perspective than most everybody else you see in the financial world. Um, and I get financial updates off Ready News. I get financial updates from the Online Investor. But as I kind of piece all of this together, uh, this see how to say this well. So I piece it all together. Oil remains on everybody's watch list. There's a lot of people buying up oil in lots of different pockets. Um, Banking, I mean, with the Fed pausing rates, banking and business development will take off again. Technology will still be like, even if the technology bubble pops, we're still going to have a technology surge, I think, just because of how much our society is dependent upon and how much we use technology. But I think those prices overall could drop a little bit. Uh, but then of everybody I read, I have not seen anybody recommend that CHW fund in at least in the last 2 years. I'll put it that way. But this is the interesting thing about closed-end funds. When you track the data, you track it routinely. I track data every single week and then update the whole system every single month. When you sort all the data and you base it on discount overall, and you base it on the current discount in relation to the historic and the 5-year discount, and you kind of take everything into effect, you can sort out a lot of companies that is as fun as they are to own, as fun as they are to, I mean, they pay wonderful dividends. As much as I love those funds, I can, you know, query them all out and focus on the funds that are significantly discounted and that pay a healthy, high, sustainable dividend, and who can, yeah, they can perform in the current market, but they can also perform where I think the market is headed, because the market always looks forward. I mean, you can plan your portfolio on today. Sunday, market's not open. You could plan your portfolio where you think the market will be Monday, but you'll be better invested, maybe have a better vision for your investments if you can look into the future. Oil, regardless of what you think of green energy, will be around for, I think it'll be around for forever. I read an article where uh, the writer and investor was saying oil's not going away. I mean, most people think it's here for another 30, 40 years, but oil is used, and its byproduct is used for so many things that you just don't realize how pervasive or invasive or integrated it is into our society. So to cut it out of society and say, hey, we're not going to harvest any more oil, then that will negatively impact our economies, but it'll also just negatively impact society, because so much of our society is based upon oil. So oil today is up and down, but oil over the next 30, 40, 50, 60, however long it's around, right, is projected to do really well. Technology now versus technology in the future. Uh, Private equity, business development now based on the Fed's role versus in the future. Small business startups are always happening. And even large scale small business startups are always happening. And lending to that will always be needed. It'll be scanter pending what the Fed does, or it'll be plentiful pending what the Fed does. So if you can see your portfolio from a long-term perspective and not just today, I mean, yeah, the current 9% yield is today, right? But if the stock goes up or the dividend goes up, that's going to impact your yield the next time you buy it, or it may or may not impact your yield at all. If you buy it low and the dividend goes up and you never sell it, then you've automatically increased your dividend. I guess what I'm trying to say is, don't, my advice would be, don't buy it based on today. I mean, yeah, the price is today, that factors in, right? The 9% dividend is today. That's what matters. The discount is for today. That's what matters. But you're buying the actual fund for its performance years later, not so much what it's going to do Monday when the bell rings. So, all right, disclaimers said. Uh, disclaimers, yeah, completely disjointed, which goes with the unedited raw video. So, as you go through the week, just remember you're the captain of your ship. You have the power to change your life and your financial future. Many people, and there are many people who would like to help you, but only you can make the choice to do it, and only you can make the choice to follow. or maybe only you can make the best choice on who you follow. So whatever you're up to, whatever you're doing, whatever your strategy is, by all means, make it happen and then shock your world. This is Daniel Young signing off. I will see y'all on the next video. Bye-bye.